So, you want to learn how to make an assload of money as fast as possible while your wife is begging for money to spend on her boyfriend. Well, you came to the right place. In another video, we covered the possibilities of options trading and how you can sit on your ass and make hundreds, if not thousands of dollars a day. But today, we'll dive deeper into what options are, types of options, how they work, key terms and components, benefits of options, and lastly, the risk of options. Options, in the world of finance, are powerful financial instruments that provide the holder with a unique set of rights and opportunities. There are two primary types of options, call options and put options, each with its distinct purpose and function. A call option grants the holder the right, but not the obligation, to buy a specific asset, typically a stock, at a predetermined price known as the strike price. Imagine it as having the option to call for an asset when the conditions are favorable. This right can be exercised within a specified time frame, known as the expiration date, which adds a sense of urgency to the decision-making process. On the other hand, a put option provides the holder with the right, but again, not the obligation, to sell a particular asset at the same predetermined strike price. Think of it as having the option to put an asset up for sale when it's advantageous. Just like with call options, the holder must make this decision within the set expiration date. These two types of options form the foundation of options trading, allowing investors and traders to create various strategies to achieve financial goals, hedge risks, and navigate the ever-changing landscape of the financial markets. Now, let's dive deeper into how options work, starting with an important concept called the premium. The premium is the price you pay to acquire an options contract. Think of it as the cost of having the potential rights and opportunities that options offer. The premium is determined by several factors, including the current market price of the underlying asset, the strike price, the time remaining until the expiration date, and market volatility. It's essential to understand that options contracts are often standardized, with each contract representing a specific amount of the underlying asset. In most cases, a single options contract corresponds to 100 shares of the underlying asset. This feature is known as contract multiplier or contract size. This aspect of options is where their power and leverage become evident. By controlling 100 shares of the underlying asset with a single options contract, you can effectively control a more substantial position than you would with stocks themselves. This leverage can amplify both potential gains and potential losses, making it crucial to have a well-thought-out strategy and risk management plan when trading options. So, when you buy or sell options, keep in mind that you're not dealing with just one share of the underlying asset. You're dealing with a contract representing 100 shares, which allows you to potentially profit from the price movements of a more extensive position with a comparatively smaller investment. One of the standout features of options is their ability to provide leverage. Leverage allows you to control a more substantial position in the underlying asset with a relatively smaller investment. It's like having the power to move a big boulder with a lever. With options, you could potentially amplify your returns when the market moves in your favor. However, it's essential to understand that leverage works both ways. While it can magnify profits, it can also amplify losses. Therefore, careful risk management is crucial when trading options. Options are incredibly flexible financial instruments. They offer a wide range of strategies that cater to various trading objectives and risk tolerances. Whether you're looking for income generation, capital appreciation, or risk mitigation, there's likely an option strategy that suits your needs. Some common strategies include covered calls, protective puts, straddles, and strangles, among others. This flexibility allows you to tailor your approach to match your specific market outlook and goals. Options can be powerful tools for managing risk in your investment portfolio. For instance, you can use options to protect your stock holdings from potential downside risk by purchasing put options, effectively ensuring your portfolio. Additionally, options can be employed to generate income or enhance returns in a more conservative manner. By employing risk management strategies with options, you can navigate turbulent market conditions with greater confidence. In summary, Options provide leverage to magnify potential returns, a wide array of flexible strategies to suit your objectives, and robust tools for managing and mitigating risks. However, it's essential to approach options trading with a solid understanding of the mechanics, a well-thought-out strategy, and disciplined risk management practices to fully harness these benefits. Options contracts have a finite lifespan, defined by the expiration date. Once an option expires, it loses all its value and ceases to exist. This limited time frame means that you're operating under time constraints. If the underlying asset doesn't move in the anticipated direction before the option's expiration, it can lead to a loss of the entire premium paid for that option. This time sensitivity adds a layer of complexity to options trading, and it's crucial to factor it into your decision-making process. Options are highly sensitive to price fluctuations in the underlying asset. Small movements in the price of the underlying can result in significant changes in the value of the options contract. This price sensitivity is known as delta in options terminology. Depending on your options strategy, price movements can work for or against you. It's essential to have a clear understanding of how delta impacts your positions and to be prepared for potential volatility. When you purchase an options contract, you pay a premium up front. This premium represents the cost of the option and is non-refundable. If the option doesn't move in your favor or if market conditions change unfavorably, you may not recoup this premium. The potential loss of the premium is a critical consideration when evaluating the risk-reward profile of an options trade. It's worth emphasizing that options trading isn't a guaranteed way to make money, and it's not without its challenges. Successful options trading requires a solid understanding of the underlying assets, market conditions, and options strategies. Additionally, it demands discipline in risk management and a well-thought-out approach. To mitigate these risks, it's crucial to have a clear trading plan in place, set stop-loss orders to limit potential losses, and diversify your options positions to spread risk. Remember that education, practice, and continuous learning are key to mastering options trading and making informed decisions. In summary, options enable profit through strategies like buying calls or puts, providing leverage for market gains. They act as risk management tools, guarding against losses and spreading risks across market scenarios. A solid grasp of concepts like delta and theta is essential for success. Options can magnify gains and losses, hence, disciplined risk management is critical. Approach options trading with knowledge and discipline, as they can be valuable additions to your investment strategy, but remember, they're not without complexities and risks. If you found this video useful, don't forget to like and subscribe as there will be additional videos uploaded for this options trading series.